Good morning. Good morning and welcome. I'm Mike Skelton, President and CEO of the Business and Industry Association of New Hampshire. We proudly serve as New Hampshire's statewide Chamber of Commerce and our State Manufacturing Association. And in our role as State Manufacturing Association, we are proud to be the official state affiliate of the National Association of Manufacturers. Very pleased to partner with NAM today and excited to work with them throughout the year, and excited to have Chad Moutray, their chief economist, with us to offer some insights on the state of our economy and what's ahead. Few housekeeping items before I formally introduce Chad and hand the program over to him. Also want to say thank you to New Hampshire MEP, the New Hampshire Manufacturing Extension Partnership, for serving as a partner for today's webinar. Appreciate all the work that they do to support New Hampshire's manufacturing sector alongside the BIA. And then at the conclusion of Chad's presentation, we are going to have time for Q&A. So would encourage you to use the Q&A feature on your screen to submit questions. We'll try to get through as many as we can with the time that we have. So with that, I'm pleased to introduce Dr. Chad Moutray. Chad is the chief economist for the National Association of Manufacturers, where he serves as NAM's economic forecaster and spokesperson on economic issues. He frequently comments on current economic conditions for manufacturers through professional presentations and media interviews, and has appeared on a number of news outlets and media outlets. In addition, he is the director of the Center of Manufacturing Research at the Manufacturing Institute, the workforce development and education partner of NAM, where he leads efforts to produce thought leadership, data, and analysis of relevance to business leaders in the manufacturing sector. He holds a PhD in economics from Southern Illinois University at Carbondale and a bachelor's and master's degree in economics from Eastern Illinois University. He is a certified business economist, where he is part of the initial graduating class in 2015. Chad, thanks so much for joining us and looking forward to your presentation this morning.
Thanks, Michael. And I have shared my slides, so hopefully everyone can see those. And a lot to talk about in the economy. So let's just dive right into it. As was said, I'm chief economist at the NAM, as well as I run the Center for Manufacturing Research for the Manufacturing Institute. So lots of workforce conversations, which I'm sure will be something that we talk about even in the Q&A. So let's go and talk. Here we go. Start with this one. This is the NAM Manufacturers Outlook Survey. Actually, we're getting ready to go in the field on Thursday with the Q1 survey. So look for something to come out in March on where we are in the first quarter. But as you can see, we ended last year down from the historic average. Roughly 3/4 of our members are positive at any given time over the history of the survey. You've got to pick a bucket. You're either positive or negative, and so that gives a little bit of a higher average. And you can see that 66% of our members were positive about their company's outlook in December. That number really didn't budge that much over the last 3/4 of last year, really averaging kind of in that same range of 66%. It was slightly higher in terms of the percentage, although probably not statistically significant in terms of that difference. And I think one of the things that I kind of walked away with, despite it kind of ticking slightly higher in terms of that positive number, I found that most of the respondents were slightly a little bit more negative in their responses in December. Part of that, I suspect, could be we had some pretty sharp increases in interest rates for part of that time, and there was, I think, still lingering uncertainty. I wouldn't be shocked if we see a little bit more positive reading when we get the first quarter, but I don't want to prejudge where that goes. But that negative kind of sentiment kind of came through when you're looking at the expected growth rates. And so you can see here, when we ask manufacturers about the expected growth rates for sales, production, exports, capital spending, and hiring, each of them pulled a little lower in December than where it was in September. Now, I think it's notable, though, right, that none of these numbers went negative, right? I've been in this job 13 years, long enough to remember when expectations were negative, right? That there was a lot of pessimism or uncertainty out there. And I think mostly what I have heard from our members is that things have slowed, right? But it's not like you're seeing these expected growth rates that are negative. And you see that not just in our survey, but other surveys as well, right? Where even where you see a much more challenging environment right now, if you're looking at the regional Fed surveys, for instance, that go out 6 months, those also have largely still been positive. When you're looking at the change between the fourth quarter and the third quarter, you see a little bit of that negativity in there as well. You have more folks on the negative side than on the higher side. But the bulk of our members actually just stood pat, right? That was especially true for hiring and capital spending in the fourth quarter. Again, I think I'll be looking at this number when we get the first quarter to see if that flips around a little bit, and you have a bit more positivity in there. The number one issue for 5 straight quarters, and I wouldn't be shocked if it's 6 straight quarters, is attracting and retaining a quality workforce, right? This is the issue that I hear everywhere I go. Small, medium, and large companies, every sector says that they're having trouble finding talent. I also hear that it's easier today than it was, say, 3 months ago, 6 months ago, 1 year ago, right? So you definitely have seen some cooling in the labor market, which has been pretty welcome. But the labor market is still tight, and you still are having issues with attracting and retaining talent. A couple of the things that are on this list just to note, and the first one just to bring up is unfavorable business climate. When I started at the NAM, that was the number one issue for several years, right? It fell down the list starting in 2017 after the tax cuts. And it's starting to rise back up the list again. And so that reading actually is the highest it has been since 2016. And I think it's largely a recognition of 2 things. Number one, there's a huge regulatory onslaught. That's a word we use quite a bit at the NAM, coming from Washington. I happen to sit in the policy office, and so I see all of the comment letters that are going out the door, about 100 regulations or more that we're following. And so that, I think, kind of constant drumbeat of regulations is one of the aspects of that. The other, obviously, on the tax side, there's the conversation about the tax trifecta and R&D tax cuts. But I think that there's also a recognition that whoever wins the election in November will shape taxes for the next decade, because those 2017 tax cuts expire in 2025. And so that will be the conversation that we're going to be having from a policy standpoint as you move through the end of this year and into 2025. The other comment I'll make has to do with things that have been number one in the last year or so that have moved down the list. One of them is inflation, and the other is supply chain challenges. They still are issues, and where they are issues, they are still significant issues. But those have moved down the list and are now in was it 5th and 6th place relative to where they were, say, a year ago, where each of them were much higher on the list. The other thing to note is that more of our members, at least in December, felt that that a recession was less likely. This number, we're going to be asking this question on Thursday as well, so we'll see where this goes. But you can see that a little bit more than a third of our members felt we were going to have a recession this year. A quarter of them thought we weren't, and 41% were more uncertain. So a little bit more of a mixed bag in terms of where folks thought that the economy was headed this year. My own forecast would be that this number continues to dwindle, right? I think the soft landing consensus has become a little stronger, and so I wouldn't be surprised to see that yes category pull back a little bit when we do the first quarter, but we'll see where that goes. So if you think we're in a recession, in terms of I mean the manufacturing sector, you probably are looking at ISM. So this is the Institute for Supply Management's Purchasing Managers Index. Just a little refresher that numbers under 50 are a contraction, numbers over 50 are expansion. And for most of the last year, the ISM numbers have been below 50. In fact, for the overall headline number is still below 50, right? Even in January. But I tend to be a glass half full guy, and one of the things that I have noted about both the U.S. numbers, but also the global, which we'll focus on in a second, is that they have trended in the right direction in recent months. And so you can see here when you're looking kind of at that overall trend line, we had production actually that expanded a bit in January. And that overall number that we see for the overall Purchasing Managers Index was really the strongest we'd seen in a little over a year, right? And so I think that things are stabilizing, and you see that again, not just in the U.S. PMIs, but global PMIs as well. Even though the overall managing sector continues to be challenged, is my word, I do think that you're starting to see that rate of decline slow, right? And so that stabilization, I think, is welcome. I do expect that these PMIs will go over 50 in the coming months, for instance, and so that should give us a bit of encouragement as we move forward. On the manufacturing production side, and we'll be getting new readings for this, I think, next week. So this was just showing you the last 6 months of 2023 on this chart. Quite a bit of choppiness here, right? A lot of the choppiness that you saw, especially in October and November, were related to the motor vehicle sector, the UAW strike. And so that led to the tremendous declines we had in October, bit of a rebound in November, which carried a little bit into December. Although you can see here, we just edged up a little bit in December. And one of the charts I like to look at when you're looking at these overall figures is to kind of step back a bit. Because the manufacturing numbers are pretty mixed, right? You do hear a little bit of good and a little bit of bad, and I think this chart, while it certainly is showing you a decline in manufacturing production and capacity utilization, gives a little bit of an explanation of why those numbers are a little bit more mixed. And so, one of the things that I hear when I travel around and talk to our members is that yes, things have slowed down or they pull back, but if you're going to pull back, at least you're pulling back from a strong base. And you see that on this chart, right? So if you go back, both of these numbers peaked off in April of 2022, right? In April of 2022, capacity utilization was 80%, the highest it had been since the year 2000. And manufacturing production was the strongest we'd seen in 4 years, and so since 2018. So quite a bit of growth coming out of the pandemic, and you kind of peaked off at that point in April of 2022, and things have pulled back since then. But manufacturing production has pulled back 1.7% since then, right? So this is not like pull your hair out. This is, we haven't seen the bottom fall out of the sector, right? It's not like you're seeing these huge declines that we've seen in this case, you're looking at the pandemic decline, but even in the Great Recession, pretty similar declines. The bottom has not fallen out. You've seen a little bit more stability there than I suspect that some of the press might suggest. Capacity utilization has pulled back a little bit more than that. It's pulled back about 3.5%. But again, these are not like pull your hair out levels of declines. Now, I say that overall in the aggregate. When you pull back and you look at the data for the various sectors, you see a lot more variation there, right? So this is just looking at the December data. You can see a very mixed overall from a sector by sector basis. Keep in mind, to go back a couple charts, manufacturing production was up 0.1%, so essentially stagnant. So it would make sense here that these numbers are a bit more mixed. More interesting to me is what it looks like over the last year, right? And so when you look at it on a year-over-year basis, you can see some of the winners and some of those that are really struggling, right? Some of those sectors at the bottom of the list probably are in a manufacturing recession, right? And so they're really trying to come out of that. But at the top of the list, you see obviously petroleum, you see computers, no sort of shock why that's towards the top of the list, given all the technology investments. Aerospace, right? The backlog that we're seeing there. Motor vehicles has obviously bounced back and done much better. Chemicals, primary metals, etc. When you look at the word chemicals, insert the word pharmaceuticals, because that's a large part of what's carrying the chemicals sector a little higher in this particular chart. So again, lots of variation in that comment, but I think it is notable that there's quite a bit of stability there, a little bit more stability, I think, than you get when you hear some of the mainstream press talk about the manufacturing sector. And the same would be true for overall manufactured goods. So this is the number that we got last week. So if you get my Monday economic report, you saw me write about this earlier in the week. A very similar story to what we had with manufacturing production, where we had quite a bit of instability there because of the UAW strike. And overall factory orders are choppy in general because of the timing of aircraft orders. So we tend to strip out transportation equipment in a lot of these data points. But you can see here a lot more growth than you might expect, right? So 0.2 and 0.4, but really, and if you're looking at the red bars here, Only one of those months was a decline, and that was, again, the UAW strike kind of induced decline. And so that brings you to overall factory orders, and you're looking at this overall leveling. And on a year-over-year basis, manufacturing production is up about 1%, a little over 1%, right? And so, again, a bit more stability there than I suspect you might hear otherwise. The other kind of number that I like to pull out of when we look at the factory orders number, excuse me, is core capital goods spending. So this is the proxy for capital spending in the economy, and I should add a little asterisk after each of these last 3 points. These are nominal numbers, so if we were looking at it in real terms, stripping out prices, that might not be quite as rosy, but still would gives you a nice storyline there. So core capital goods spending is either at or near an all-time high for new orders and shipments. And so this is a sign to me that the businesses are reinvesting in themselves, right? You hear a lot of stories about investments in automation and technology and R&D and a lot of other things, which to me are reasons to be optimistic about productivity growth moving forward. But these are not just all-time highs, but you can see just a pretty stratospheric level of growth here in terms of core capital goods spending. Somewhat leveled off a little bit here in the last year, but still hitting either at or near all-time high. So that, again, is a nice encouraging sign. And kind of consistent with that is this chart. So this is the number. This gets a lot of attention, as Michael knows. This gets a lot of attention in Washington, right? This is private construction spending in manufacturing. And this is not just an all-time high. This is just a whopper of a number, right? Up just about $213 billion, up 60.7% year over year. So I call this the hockey stick, right? This tremendous increase in construction spending. A lot of it is industrial policy, right? So it's the CHIPS and Science Act and all of the semiconductor investments you're seeing around the country. It's the investments in EVs and batteries and some of those energy components that were part of the Inflation Reduction Act. A little bit of it could be the bipartisan infrastructure bill, although quite frankly, the bulk of this is coming from CHIPS. I think a large part of this also is just reshoring, the fact that so many manufacturers are looking at the U.S. and North America differently, and the U.S. is certainly benefiting from that in kind of some real investments. So this is the chart, right? Again, it gets a lot of attention, particularly given the industrial policy elements from it, from the Biden administration. But what I like to kind of add to this conversation is that this is just shovels in the ground, right? None of these factories are up and running yet, right? It takes a while to build a factory, right? So this is just shovels in the ground. They've probably done a ribbon cutting, et cetera. That's it. Every one of them has a help wanted sign attached to it. And so Goldman Sachs estimates that we're going to need another 250,000 manufacturing workers to fill all the jobs that are associated with this in an environment where the labor market is already pretty tight. And so, again, it shows you where, again, it's not hard to be optimistic about manufacturing moving forward, given all the investment that's happening here. In my view, we've hit a bit of an inflection point. These numbers are probably going to level off at some point over the coming months. But again, you're leveling off at record levels, and so that's a nice, encouraging sign. So before we do employment, I'm gonna flash over to do the global story, and then we'll come back to doing some of the other domestic storylines. So this is me with a glass half full version, and that is that this chart continues to show more blue on it than it has. If I were doing this presentation for you 3 or 4 months ago, this would have been a sea of red. And so you are starting to see, much like I said with the ISM, some signs of stabilization, even in the global economy. Now, the global economy remains challenged, right? But you can see here in January, this is a new number that we got just this week. The global manufacturing PMI has stabilized. It's 50, right? So it's exactly neutral, right? You're seeing better data for the US in this particular reading as well. It actually has gone over 50 for the JP Morgan figure. And you have 4 economies that, so this is looking at the top 10 markets we sell into, 4 economies that have manufacturing growth in them in the month of January. In December, that was 2. So we've doubled the number of countries that were growing. The 2 additions were Brazil and South Korea. Prior to that, in December, it was just Mexico and China. You're probably questioning why China is blue here, given all the press that you hear about China and all the overbuilding and all the over-indebtedness and the fact that people aren't coming back after zero COVID. And it has everything to do with the fact that, yes, all those things are true, but you're seeing slightly better data today than you were 3 or 4 months ago. And so this is a dynamic figure that's looking at change this month versus last month. And so you are seeing some progress there. It doesn't take away from the fact that probably China is going to grow slower this year than last year, right? But nonetheless, they are growing. Mexico is perhaps not a bit of a surprise. Mexico is really benefiting from that reshoring and nearshoring move. And in general, you're seeing weakness in Asia and in Europe. Europe obviously is getting hit from slower global growth in general, but also from the kind of that lingering Ukrainian war effect. So the good news here, because I like to focus on good news, is if you're looking at these PMI numbers, 8 of them had higher PMI numbers in January than in December. So that's a nice positive. And this kind of shows you that in a different way. I'm probably the only economist that uses candlestick charts, which are a little bit more common in the stock market trading. But I like to show it because it shows you where these numbers have gone over the last 6 months. So if it is green, it means that the PMI number today is higher than it was 6 months ago in July. Lots of green on this chart, which is very encouraging. If it's red, it's the opposite of that. But even some of those markets that are red, such as Mexico, are still growing, right? So there's a bit more stability in the global economy than I think it's getting credit for. The other note here is that the dollar has in general, is following monetary policy is the best way I can say this. So we were seeing the dollar soar up until the beginning of last October as interest rates continued to rise, and there was this more hawkish stance on the part of the Fed. If you remember, if you go back to late September, early October, 10-year treasuries were 5%. Mortgages were approaching 8% for a 30-year fixed rate mortgage. And the dollar was rising, right? So you had this dollar conversation really leading up until that mid-October timeframe. Since then, the Fed became a little bit more dovish, and you started getting the sense that the Fed had stopped rate increases and they were going to start cutting rates. And so the dollar really started falling from October on until you got to this year, right? So you saw the dollar fall about 4% or so, and it's risen about 2% since then. What's largely risen the dollar more recently is that part of it, quite frankly, is that other countries are matching us, but also the Fed, while it's going to cut rates, it isn't cutting it right away, right? It's not going to happen it didn't happen in January. It's not happening in March. It might happen in May. So a little bit of this is following what the U.S. does, but also what's happening abroad. I would suspect in the last couple of days, given the Fed's comments on 60 Minutes on Sunday, that the dollar has started rising a little bit. But in general, I think you've seen a little bit of a weaker dollar relative to certainly where we were 6 months ago or where we might be moving forward. So let's look at employment, because employment has been one of those things that has really kept the economy afloat. Right? It's really provided that resilience to the economy in 2023. And even with some cooling, it's likely to provide some resilience in 2024. So, we had really robust growth, 333. That didn't get as much attention, but the December number was revised up quite a bit, as well as the 353,000 for January. So really solid double expectations growth for January in terms of overall non-farm payroll growth. The overall unemployment rate remains 3.7%. So we're essentially still at full employment. Yes, we're up from 3.4 last April. That 3.4 number was the lowest since 1969, but still we're in that full employment range. I do expect us to see a little bit of a rise in the coming months, perhaps approaching 4, maybe going a little over 4. But even that's a great number, right? Quite frankly, I mean, we've never had a recession in full employment before. So if you're looking for why this time might be different, that certainly would be one of those that kind of is in that bucket. So again, it's quite a bit of tightness in the labor market. We have seen, interestingly, some people move to the sidelines in the last couple months, which is a bit of a head scratcher to me. In general, we have seen movement of people coming back into the labor market over the last year. Certainly, the prime age workers, those 25 to 54, women have largely come back in the labor market. The biggest impacts on the labor market participation are those over 55, a lot of accelerated retirements, and younger men with less education. Although even the younger men with less education you're seeing some strides of people moving back in. So I actually expected to see that number bounce back up again when we got the January data. That hasn't happened, so we'll see as we move into February. I would expect to see a little bit of improvement there. But again, in general, we've seen some progress there. On the manufacturing side, again, lots of volatility here with this number, largely at the end of the year because of the UAW strike. In general, we were pretty stagnant in terms of our job growth in 2023. We added 22,000 workers on net. So not a phenomenal year in terms of manufacturing employment growth, although we ended the year on a pretty strong note and began this year with a pretty strong note of 23,000. But those are coming off of two really, really good years in 2021 and 2022, right? Those 2 years were the best 2 years of manufacturing growth we had seen since the mid 80s, right? And so we largely sustained that number, right? And in fact, if you get the Monday report, this was the headline this week. We are just shy of 13 million workers in manufacturing. I think it's 12.98 million workers in manufacturing, the most since November 2008, right? I expect that manufacturers will add at least 100,000 workers this year. It could go over that, given my comment that I made about Goldman Sachs earlier. I expect by the time we get to the end of 2025, we'll be 13.2 at least. So I do, we're going to continue to make some strides in moving that number higher. I keep waiting to break that 13 million threshold. We get stubbornly haven't done it, but we're getting a little closer to it. We have seen cooling in the labor market, and you can see that in a number of places, right? Again, anecdotally, you hear that in talking to HR folks. But we still have a little bit more than 600,000 job openings in manufacturing, right? So that's still a pretty elevated number. I've been in this role long enough to remember when 400,000 or 450 was a great number, right? So we're still well above pre-pandemic levels for job openings. The cooling that you see, though, probably is largely at the bottom of this chart, right? Which everyone focuses on the red line, but you can see that hiring activity also has slowed. And so those are obviously the slowest since the pandemic. But you're moving kind of in tandem, both hiring and separations there. The other area that gets a lot of attention, and if I were doing this presentation 2 years ago, you would have all complained to me about churn, right? People leaving you, going across the street and making an extra 25, 50 cents an hour or $1 more an hour, right? Lots of churn, lots of quitting. There was a record level of quitting at the beginning of 2022. We've seen the quits rate, both for manufacturers and for non-farm economy, pull back, and they're approaching pre-pandemic levels, right? So again, if you're in HR, this is welcome news to you. A sign that churn is slowing down a bit, and that should mean that's a little easier, perhaps, to find workers. It should mean that. The bottom line, though, is even though that's easier, the reality is we still have more job openings than people who are actively looking for work, right? This is why this is still the number one issue. We've seen some narrowing there, right? Certainly in the last 4 or 5 months. But we still have, for every 100 job openings, there's still roughly 60 people who are actively looking for work, right? So this is why everybody is scrambling for talent, right? No matter what sector you're talking about, everyone's scrambling for some of those same workers. And so, kind of around numbers, this is basically 9 million job openings to roughly 6 million unemployed Americans in the U.S. And demographics are going to keep that to be a top issue. Now, this chart probably needs updated. I stole it from the Wall Street Journal, and so obviously the death rate, now that we're past the pandemic, is hopefully fallen from where it was during the pandemic. But you can see here that gap between births and deaths has narrowed in general over the last few years, and with more retirements, this is going to keep demographics and that overall job issue of where the workers are going to come from front and center for manufacturers moving forward. As a result of all of that competition, wage growth has been really solid, right? So this is manufacturing average hourly earnings for production workers. And just to put some numbers behind this chart, this number went up 0.9% in November, 0.9%. These are monthly gains, 0.9% in December, and 0.3% in January, right? Up 5.3% year over year. So you're still seeing really solid wage growth. Despite some cooling, you're still seeing quite a bit of wage growth here. This is $27.15 an hour. As that's the national average. Obviously, lots of variation by region, lots of variation by occupation, but still a really solid number. Overall, for all workers in manufacturing, the average is $33 an hour, right? So we still pay more than most of those other sectors, but you've seen that gap narrow pretty significantly. I expect this will cool off a bit and probably get down to the 4-ish range on a year-over-year basis by the end of the year. But that hasn't happened yet, and we still see that number being pretty stubborn. Which brings you to talking about inflation. So I'm going to show you 3 charts on inflation. Each of them has a similar storyline. I always start with this one. This is the preferred measure for the Fed. So this is the personal consumption expenditures deflator, or basically the price index for personal spending. So I'll go through them here, and then I'll tell you the storyline, right? So there's that one. We're going to get next week. We're going to get a new reading for the producer price index. These are basically wholesale prices. A bit more moderation here than in some of the other readings, and then the consumer price index. Notice they all look fairly similar, and that you're seeing pricing pressures moderate, right? In general, these year-over-year numbers are slowly but surely edging lower, right? And so that's obviously what the Fed wants to see, and so you're seeing some progress there. The Fed's goal, right, for its preferred measure, was to have 2% core inflation, and the Fed confirmed that last week. Jay Powell talked about that on 60 Minutes on Sunday. So that's the red line, and we will get closer to the Fed's target of 2% by the end of the year. I don't think we'll get to 2, but we'll get closer to it, right? And so that's obviously progress, and hopefully will allow the Fed to kind of take the foot off the gas pedal a little bit as you get closer to that number. Keep in mind, this is just simply a year-over-year number, so it's part of this is moving down because of math, right? Your comparison month continues to get more favorable, right? And so from a pure math standpoint, that's what's pulling these numbers a little lower. But the challenge for the Fed is that some of the low-hanging fruit are already gone, right? And you're still seeing quite a bit of stickiness in inflation, right? If you fly anywhere or stay at a hotel, you know how expensive it is, right? Transportation services are still pretty elevated. Rents are still stubbornly high, although most would argue that's probably a lagged indicator, but they're still pretty high. Wage growth, as I noted, is not part of this measure, but certainly is going to continue to keep some of that pricing pressure in there. And so the Fed, while they were going to start taking their foot off the gas pedal and potentially cutting rates as soon as May, they're only going to do that 25 basis points at a time, and they're still going to stay more elevated than you might prefer, trying to make sure that they completely tackle inflation. So I will address one comment here, which is we often make the case that inflation is moderating, and that is true. Yet when you ask most Americans about inflation, it's still the top issue or one of the top issues. And that's largely because the growth in inflation is slowing. Doesn't mean prices are falling. And most Americans, when they go to the grocery store, recognize that prices today are a lot higher than they were 2 or 3 years ago, right? And so that plays into the consumer sentiment numbers that obviously will have an impact on the election kind of conversation. But it's important to note that when we talk about moderation of inflation, it's simply looking at the growth rate. No one really is saying that prices are going to fall. When you're looking at GDP, this was also a pretty strong number, right? For the fourth quarter, I was expecting roughly a 2% or so for GDP growth in the fourth quarter. We ended up getting a lot better number than that, 3.3% growth. I see us growing right now in the quarter we're in, kind of also in that low 2 range. There are now casting estimates that have it at 4. We'll wait to see. That's still early on. I don't think it'll be that strong. I do expect to see some cooling off as demand slows a little bit over the coming months, but I don't see us going negative. I've long been, as Michael knows, in the soft landing camp. I think that resilience in consumer spending is going to continue to keep the economy afloat. A lot more people, I think, are under the belief that soft landing is more possible, right? And so I think that that will again help as well. Michael, I'm going to steal something I'm going to say a little bit later, but we've been trying to talk ourselves into a recession for the last 2 years. Hopefully we can start talking ourselves into a soft landing, right? And so I said earlier that the NAM survey, 34% of our members thought we were going into a recession. In some of the more recent consumer confidence numbers, those numbers have been hovering around 3/4 of our of consumers thought we were having a recession in 2024. That's slowly starting to pull back a little bit, so it's now around 2/3. That number hopefully will continue to move lower, and as that continues to move lower, hopefully that will help overall consumer spending. Doesn't mean the consumer's in great shape, but it means that they are still going out and spending, and you can see that really is what's propelling some of the growth that we had in the fourth quarter was service sector spending, non-durable goods spending, a little bit better data for exports, and some of these other measures. There was no drag coming from any of the measures of GDP in the fourth quarter, which I'm sure you all love from your econ class, the C plus I plus G plus X minus M, right? That's essentially this chart. And you can see that there was really no drag coming from any of those measures. Now, a little reality check. Even though I'm in the soft landing camp, the reality is that there are still quite a lot of downside risks, right? And the number one, not just on this chart, but I think in my view, it's in general, the number one downside risk is all the geopolitical activity out there, right? You still have Ukraine, which is an overhang for Europe. You have what's happening in the Middle East, right? And we see what's happening, obviously, with freight costs because of the Houthis, right? In terms of the Red Sea, et cetera. So lots of geopolitical risk. I don't even have Taiwan up here, but Taiwan could be added to that list. So lots of is happening geopolitically that could certainly be something that could really dampen this enthusiasm. I have global growth up here as a downside risk. I mean, the reality is it probably is a little bit of both because I do think that number has stabilized a bit, but still is weaker than we would prefer. And so that's why it's at the top of the list. I've already mentioned talking ourselves into recession. Some of these other red flags to watch they've probably lessened a little bit in the last couple of months. Certainly the fiscal spending uncertainty. I mean, there is still a chance of a government shutdown kind of out there, but hopefully that will be averted. I think the student loan paybacks was a little bit less than advertised as far as an issue in the fourth quarter. But I do expect we'll continue to see labor issues, right? That UAW strike certainly had a lot of influence in terms of the data, but could potentially spur on some additional labor issues moving forward. On the upside risk, the Fed is definitely in a cutting mode, right? So they are not going to raise rates anymore, and so they're going to cut rates at least 3 times this year, more than likely. I think the market is reacting to the fact that it probably won't be March, but it still could be May or June for that first rate cut, and so that provides a bit of an upside risk in general for because you're moving in the right direction. The stock market might not like it because it's not as soon as they like, but there is still a bias there towards cuts. To me, the path to a soft landing has always been through the labor market, right? Go back to kind of a comment I made earlier. If you're looking for how this time is different, we've never had a recession and full employment before, right? And so I think the fact that we have had a strong labor market, continued wage growth that's been pretty solid has really provided that resilience on the consumer side that has really kept things afloat. And that really, I think, is a bit of a surprise for folks who were expecting a recession at some point in 2023. And then the last part of it here is just all the spending that's happening, right? That hockey stick that I mentioned earlier, that has provided quite a bit of a, pushing back against this notion that all the other challenges that are out there. In terms of manufacturing production, obviously we had a weak 2023. I see us growing about 1% this year. So again, nothing really to write home about, but at least it's a movement in the right direction. So that's an awful lot to cover in a very short period of time. So I'm ready to take your questions. I'm going to stop sharing my screen here.
Awesome. Thank you, Chad. That was great. A lot of really excellent information covering a lot of ground. We do have a number of questions that have been submitted, so I'm going to try and work through as many as we can in the time that we have left. Starting with workforce, That was a pretty big number you mentioned in terms of Goldman projecting 250,000 workers needed for manufacturing.
Yeah.
We had a question about what you see as the impact of automation in making up that shortage, and is there a kind of a consensus building around what impact that might have?
We definitely are seeing a lot more automation, right? I mean, we know that as a country, we purchased more robots in 2022 than any year in history, right? That number was almost certainly higher in 2023, right? And I think workforce is part of that conversation, especially for entry-level talent, right? Or jobs that probably no one wanted to do anyway, right? I think that you are certainly seeing some automation kind of filling in some of those gaps. Uh, the reality is no one really is being fired as a result of it. So we at least are right now are not seeing that substitution effect, right? That most manufacturers that I talk to say, yes, we're putting in more robots, putting in more automation. But if someone was already doing that task, they have been upskilled and moved to some other role in the factory. And so in a tight labor market, you can't really let anyone go. I think it's simply a matter of moving folks to different roles into the shop floor. The other comment to make here is that, I'm not really one of those guys who think the robots are going to take all of our jobs away. I think there's always been a bit of a scare tactic there. I think it changes the type of worker we need. It changes the type of training you need to do, but I think that those are elements that I think are going to continue to be more necessary as we move forward and continue to automate and make manufacturing much more advanced.
So next question, and you alluded to this in one of your slides in terms of wages, but the question is, given the challenge employers are having in attracting and recruiting talent, what impact is that having on wages for both skilled and unskilled workers? So if you just want to expand a little bit more on
Yeah.
that topic.
I mean, the reality is I've heard from our members that they've had to raise wages several times over the last couple of years to stay competitive, right? When you're thinking about entry-level talent, I think the reality, so that those quite frankly, we're competing with sectors I don't think we ever thought of ourselves competing with before, right? With restaurants and with Amazon and gas stations and the overall service economy, right? I think we always thought of ourselves as competing with other manufacturers, but we're competing with a lot of non-traditional players, right? And so that has made it much tougher, I think, to find entry-level talent, right? And that's where you've seen a lot of the upward pressure for wages is on that entry-level side. But it's not limited to entry level. The reality is every manufacturer I talk to says they can't find enough engineers. You also hear quite a story about the other trades, right? Welders, mechanics, et cetera. So I think that there's also upward pressure for wages for them. And I think we've also had to think as a sector, we've had to think a lot more creatively about how we recruit into some of those areas, right? How do we differentiate ourselves from other competitors? How do you emphasize the role of culture or employee engagement or professional development? Who are you trying to go out and recruit, right? In terms of going beyond the normal populations. So I think it has changed a lot of that in ways that, in the old days, you were probably recruiting more locally. And now I think some of those, looking for those skilled occupations, you have a national search, right? And in that conversation, if you're competing nationally, how does flexibility play into that conversation, right? If you're competing with a tech company where they can be hybrid or work from home, how are you competing, right? So that conversation is one that I think a lot of manufacturers are having in terms of how they're thinking about recruitment. And yes, that affects wages, but I think it affects a lot of other elements of that too.
What were the most significant contributing factors in that downward inflection point in the CPI curve in mid-2022?
So a large part of that was gas prices, right? So keep in mind that gas prices hit an all-time high. I think it was in June of 2021. As you know, as you were buying gas, you knew that. Or 2022, sorry. And so as those gas prices started coming down, right, that certainly affected that headline number in a really strong way. Food costs continue to be elevated much longer than that, but they've also started to slow down their growth more recently, despite my grocery store comment earlier. So I think part of it is food and energy. That's why you notice that we strip out food and energy. So that's part of that. I think the other element is on the core side. there's pretty significant shortages of chips and supply chain disruptions that really affected, as you all know, the motor vehicle segment. And so used car prices, because you couldn't buy a new car, used car prices just went through the roof, right? You could, and so you've heard stories of people selling their used car just because they would make money on it and, doing a little arbitrage there, right? Those prices have started to come down a little bit, especially as the auto sector has done a much better job of kind of navigating those supply chain disruptions. But I think motor vehicles are the other element that has pulled back a bit, that is of note.
You had a question about what your thoughts on the political environment to support trade tariffs against Mexico relative to the current aluminum extrusion trade case with DOC.
So I'm not a trade expert, so I'm not going to get as far into that trade case as you might want. But I think one of the bigger shocks is that here we are, the last year of the first term for Biden, and we essentially have the same same trade policies that we had under Trump, right? I think that there was this expectation coming into this administration that there'd be some moderation there, and the reality is all those tariffs are still pretty much in place. We still have some of the same trade restrictions against China and other places, and we really don't have any new trade agreements to speak of, right? And so I think that there's a frustration there, especially on the trade agreement side, that we have not been more aggressive in going out and pursuing new avenues for opening up trade, as well as on the tariff side here, the fact that many are still in place for the most part, right? And so we'll see where that goes moving forward. I think the NAM and the trade team is certainly all plugged into those topics and trying to see what we can do to help.
Great. We have a couple more we're going to try and get to before we wrap up, probably around 11:55 or so. So this is a question regarding the private manufacturing construction spending chart. The chart tracks consistently with expected inflationary costs of construction from 2018 to 21, and then increases dramatically from mid-21 to present. How does that translate to actual square footage built versus increased cost to build over the same period? Said another way, it has cost exponentially more to build, but does that mean there is more square footage being built, or it just costs more?
That's a great question. And I don't have information on square footage. I mean, I should. Those data come from census, and they're just simply looking at pure dollars. The questioner is right there. These are nominal dollars, right? And so you do have a real effect there, right? The fact that it's much more expensive to do construction, right? You see that also on the infrastructure side, right? That there's a certain set of dollars that were just be spent on infrastructure, and given higher costs, there probably are fewer projects being done, right, as a result of that. The bulk of this increase is coming, quite frankly, from chips, right? And so that's a real number, right? And so, the White House has done a good job, I think, of laying out and breaking out where much of that growth has come from, and it's largely coming from the semiconductor sector, right? And so I don't have information on square footage, but it is correct that not, if we were to adjust these in real terms, that would be a little less impressive, but still a hockey stick, even in real terms.
Question related to federal deficits, and I think Chairman Powell mentioned this in his media interviews over the weekend as well. If federal deficits could be a problem, which decade do you think it will be the biggest problem? 2030, 2040, 2050? What's your crystal ball say?
Well, I've long been a deficit hawk, so I would say now, 2024. I mean, the reality is we have $34 trillion in debt. It's going to be 35 trillion before the year is up, right? These numbers are too big. Jay Powell said this as well on Friday. I did in a 60 Minutes piece. These are unsustainable numbers, right? And so definitely by 2030, it's a problem. And who knows what it'll look like in 2040 or 2050? But this needs to be a here and now problem. And certainly by 2030, by then we'll have 45 trillion. I don't know the actual number the CBO is projecting, but it's definitely going to be in the mid 40s in terms of trillions of debt. This is just not something we can sustain.
So I have one quick one, and then I have a wrap-up question. So we had a question that, thank you for the presentation, Chad. How do we sign up for the Monday economic report? I would also just plug, Chad's a great follow on Twitter or X or whatever you like to call it these
Yeah.
days. And I know you post a lot of your reports there as well.
So the Monday Economic Report goes out to all NAM members. So if you're a member of the National Association of Manufacturers, you should make sure you get signed up for it. But I also, a little leakage here, I also regularly post it on social media, right? So I put it on LinkedIn and I put it on Twitter/X. And so that's another way of getting it. But certainly if you're an NAM member, you should make sure you're signing up for it. You can always email me and we can make sure you get added to it.
All right, so the wrap-up question, I'm actually combining a couple of questions that came in, and it was a question I wanted to ask as well. To first say that, the BIA, we really appreciate the great advocacy work that NAM does in DC and with our federal policymakers. And we're always happy and pleased to weigh in on the various issues that NAM flags that are important for our state chambers and state manufacturing associations and manufacturing members. And so I wanted to ask you, Chad, from an economist standpoint, and again, this syncs up with a couple of questions that came in related to this. What do you see as kind of the one policy issue that if you could kind of wave your magic wand, that Congress could get their act together and do something that in the short term would really help manufacturers and our economy continue to grow, stabilize, and maybe put our foot on the accelerator for some of the positive trends that we're seeing?
Well, we got to start in very topical, right? Which is immigration, which is the topic of the week, right? I mean, we need to do something about immigration. Part of that demographic challenge could be narrowed, right? If we were to just do something sensible and do something about legal immigration. So we do have something at the NAM called A Way Forward, which kind of puts our plan out there, which addresses the problem at the border, but also provides necessary relief on the visa side, right? I like to contrast the U.S. with Canada, right? Canada is taking all those smart people that we aren't willing to take, right? And so they're having their own hockey stick, no pun intended, given that it's Canada, with population growth, right? And almost all of that variance is coming from immigration, right? So all those 501 H-1B visas that we aren't accepting are going to Canada. That's causing problems for them in terms of overcrowding of schools and tax revenues, et cetera. But we would love to be in the Canadian shoes of getting a lot of those smart people coming to the U.S. instead of coming to Canada. The other element to that, obviously from a tax side, we need to continue to be competitive, right? I think we have benefited from tax reform in 2017. I think the NAM is going to be pretty aggressive in going out and saying we need to extend those in 2025. But in the meantime, we also needed to make sure we extend, this was a question I was reading along here, the R&D tax credit and the whole tax trifecta and some of those things that have kind of gone by the wayside in the last year or so here. We need to continue to stay competitive, right? We are benefiting from reshoring, but I think we need to make sure that we have the right people, the right business conditions, et cetera, to make sure that we can capitalize on those decisions. So.
Well, Chad, this has been really helpful, excellent information. Really appreciate your time and willingness to chat with us up here in New Hampshire. And thank you to you and the team at NAM for all the great work that you do.
Thank you, Michael.
Great.
For inviting
Thanks
me.
everybody for joining us. We hope to do this again soon and really appreciate your support. Again, thank you to New Hampshire MEP for partnering with us, and thank you to Chad and NAM for their support. Have a great day, everyone. Hope to see you again soon.